Today's topic is a significant policy shift by the U.S. Department of Defense, one that I'm calling the Drone Procurement Liberalization Policy. The DoD is moving away from its previous emphasis on supply chain risk and strict bans on Chinese drone components, and is encouraging domestic innovation, decentralizing procurement authority, and accelerating deployment timelines. This new framework fundamentally alters the growth logic and valuation base for drone-focused firms. The core of this policy unfolds along two parallel tracks. First, it lifts the blanket ban on Chinese drones and components, restoring procurement flexibility to operational units. Second, it broadens the Blue List certification process, enabling more commercial drones and third-party parts to enter the military ecosystem via an accelerated process. This mechanism serves as a lever to compress decision-making and deployment cycles, shifting procurement from 5-year mega contracts to rapid tech industry-style iteration. For U.S. drone manufacturers, that represents a structural tailwind. A compelling case is AeroVironment, which clearly demonstrates its competitive strength through tactical products and export potential. The Switchblade loitering munitions series has been tested in Ukraine and is rapidly becoming standard kit for U.S. and allied urban and special operations forces. With the directive to equip armed forces with small attack drones by 2026, the structural demand is already visible. In fiscal year 2025, AeroVironment delivered 14% revenue growth and has guided towards approximately $2 billion in fiscal year 2026. They maintain long-term deployments across the 5 U.S. military branches and NATO allies, and are building large-scale manufacturing capacity in Utah. The goal? Transform suicide drone technology into a billion-dollar high-margin product line and cement AeroVironment's role as a strategic supplier within defense procurement systems. During its latest earnings call, management highlighted how the potential policy shift, coupled with congressional budget support and NATO countries targeting defense spending of 5% of GDP, has propelled AeroVironment into a phase of strategic resonance with capital. Fiscal year 2025 results included $821 million in revenue, up 14% year over year. Q4 revenue reached $275 million, up 40%. Orders totaled $1.2 billion, and there was a funded backlog of $726 million, providing strong revenue visibility. Switchblade sales surged 83% to $352 million and included a near $1 billion U.S. Army contract, which is now converting into funded orders. The acquisition of Blue Halo formally extends AeroVironment into emerging defense sectors like space, electronic warfare, and cybersecurity, underpinning the $2 billion fiscal 2026 revenue guidance and signaling strong synergy confidence. Growth comes from several key product and market moves. The Switchblade 600 represents approximately 80% of loitering munition revenue. The P550, a modular AI-enabled micro-drone, is currently competing in 2 U.S. Army contracts valued at over $1 billion and could enter long-range reconnaissance programs within 2 quarters. Red Dragon, an in-house attack drone capable of operating in GPS-denied environments, offers considerable export potential and could exceed a full loitering munition class market, charting a path to a multi-billion-dollar growth curve. The backbone of these achievements is AeroVironment's agile tactical production capability. CEO Wahid Nawabi emphasized that decades-long collaboration with the DoD enables designs to transition quickly into volume manufacturing. New facilities in Utah and Texas aim to elevate annual capacity of the Switchblade series to the $1 billion level. Financially, fiscal year 2025 adjusted EBITDA was $146 million, up 15%. But the Blue Halo acquisition added $925 million in debt, split between a $700 million term loan and a $350 million revolving credit facility, raising leverage concerns. Management anticipates free cash flow will turn positive in 2026 to support continued CapEx, but any delay in budget execution or payments could tighten liquidity. A $60 million increase in Q4 unbilled receivables, likely tied to Switchblade deliveries, underscores the need for disciplined working capital management. International expansion is another key factor. In 2025, 52% of revenues came from outside the U.S., with about 24% from Europe excluding Ukraine. NATO's 5% of GDP spending target could unlock new markets for products like Puma, Jump 20, Red Dragon, and electronic warfare systems. With subsidiaries and legal entities in Germany and Europe, AeroVironment has a logistical advantage in regional manufacturing and maintenance that many competitors cannot replicate. Looking ahead, AeroVironment's growth thesis is evolving from being a platform supplier to becoming a comprehensive systems integrator. Beginning in fiscal year 2026, the company will reorganize into two segments, one focused on unmanned systems and the other focused on space, cyber, and directed energy, including cybersecurity, electronic warfare, laser defenses, and space applications. This transformation positions AeroVironment to attract valuation multiples more closely aligned with next-generation defense tech companies like Palantir, Anduril, and L3Harris, rather than traditional drone manufacturers. AeroVironment is positioned at the intersection of three reinforcing trends: procurement liberalization, global defense budget expansion, and accelerating demand for autonomous AI-driven weapon systems. While there are near-term pressures, from debt leverage to execution risk, strong technological capability, production readiness, and political risk experience suggest AeroVironment is well-positioned to lead the defense tech shift. From a risk-adjusted perspective, if they deliver on FY 2026 revenue and free cash flow targets, AeroVironment becomes a strategic long-term holding. For now, prudent investors should monitor Q1 FY 2026 execution, receivables trends, and contract progress to determine optimal entry timing.